Suppose a group of strangers came up to you and said, I have a company. It doesn't do much of anything, but sometime in the next 2 years, we'll merge with another company. I don't know what that company is yet. Would you invest in the stranger's company? What if I told you that if the strangers complete a merger, they get to pocket 20% of your investment? That's essentially what a special purpose acquisition company, a SPAC, does. They're blank check companies that raise money from the public through initial public offerings. They generally have 2 years to find and merge with a target company. Once they find a target company, SPACs often raise more money through transactions known as private investments in public equity, or PIPEs. These deals give the new investors, mostly big institutions, not like you and me, an opportunity to put money into that target. But these new investors, the PIPE investors, they often can buy those shares at a discount to what the share price might be after the target merger. So they receive a benefit that's not available to ordinary investors. The result? PIPE investors often get a better deal than you, and the value of your investment may be further diluted. Thus beware. There are lots of costs that regular investors are bearing, whether it's that 20% sponsor fee, the dilution from the PIPE investors, and fees for the bankers and financial advisors. It may be that those fees are coming out of the retail public's investment dollars. We need to make sure that investors and SPACs are being protected. Look, you as an investor get to decide about where to put your money, but companies raising money from the public have to provide adequate disclosures. I think we can enhance the disclosures that companies raising money via SPACs make. I've asked staff for recommendations about how we might update our rules so that investors are better informed about the fees, the costs, the conflicts that may exist with these SPACs. We'll also work to hold bad actors accountable and keep a close eye on all the parties in these transactions. Because at the end of the day, we need to ensure that investors are protected.
Purpose acquisition companies in an online video. Interesting new way of communicating. Actually saves some firepower against PIPE investors, who he argues are getting a leg up on regular, normal, I guess, investors, he says.
And I know we're going to David on this, but this was such a breath of fresh air. I mean, this is Chairman Gensler.
Jim, that does not sound like a man who thinks highly of SPACs. I mean,
he trashed them like you wouldn't believe. He buzz-fed them.
Yeah, BuzzFeed is one.
No, this was a remarkable video. Must be watched. You know,
the question is, I mean, we've had him on. He's been on with us. We keep waiting. We know these things take quite a while, but do you have any expectation that something is coming soon from the staff and that we will actually see additional regulation and then where it may be focused?
I'm betting, he's betting it's a chilling effect situation. That there are responsible people who say, I don't want to be on the griddle when the chairman takes aim. So he says, well, let me give you an example. You don't want to be that example. This was horrifying. I mean, if I were running a SPAC right now, I would just say, oh my, I got to solve this.
There are so many out there, and we'll get to that.
How many have been found?
Well, we'll get to all the numbers.
I mean, not everything's DraftKings.
No,
right?
I mean, listen, Gensler, new rules around marketing practices, tougher disclosure requirements, better alignment. Of course, we've talked so often about the alignment of incentives between the SPAC sponsor and the investor. That said, many of these SPACs right now are trading below their $10 issue price. Many are an opportunity because you can redeem, remember, at 10 or even sometimes $10.20. There's a bit of a yield available to you, and then every so often you hit the jackpot, a la DWAC. The Trump SPAC, as we call it, that I know a couple of people who owned it. In fact, they agreed to be part of the initial underwriting and got warrants and other things as a result of that to get the deal off the ground, and then it hit, and it was look what happened.
But is that a lottery ticket?
Yes, it's a lottery ticket. But why not own a lottery ticket if you know you're locked in? You know, you buy it at $9.80 and you know you're going to get 10 or 10.20. So that's happening.
But what happens with the BuzzFeed, David, which is down so much? What happens?
You know, I talked for weeks, remember, about redemption rates and how they weren't disclosing them immediately and how important they were. This is another example of a company with BuzzFeed where I think it was 94% of shareholders chose to redeem, get their money back, leaving very, very little in the trust account to go to the company than was originally anticipated to help fund its continued growth. And that has worried people. And so BuzzFeed shares, as you see, have been very poor. Any number of other names
You could
have
do
been
a lot of them, right?
quite poor. And then we have the winners, the Lucids of the world that are sixfold from what their issue price, or at least have been at some point, and created a massive amount of market value. By the way, we've got another big deal today.
What?
I don't know if you noticed, Getty Images. Now, there's a
I
real
remember
company.
that. That's a real company.
It's a real
I used
company.
to recommend that.
It's about a $5 billion deal. It's Neuberger's SPAC. They're talking about an enterprise value there of $4.8 billion. It's about 15 times on an enterprise value to what they anticipate adjusted EBITDA will be for next year. So there you at least, you're not talking about out years, 26, 27, 28, where you've got this huge sudden jump that we often see in these projections to cash flow positive from negative. Here you've got a business, obviously, that already has a significant amount of EBITDA, choosing the SPAC route, though, to go public as opposed to a straight IPO, $150 million pipe there. But guys, this has been one of the phenomenons of the year, and it's not stopping. Our friend Neil Danick's over at, we call it SPAC Analytics. I mean, he says this thing is just a machine. You've got 23 SPAC IPOs already to December 9th versus 62 for November. So December's running hotter. You've got 591 IPOs so far now coming in 2021. And Jim, to answer your question, 568 are seeking a deal. I mean, again, it goes back to this idea of how do you chase that many opportunities, and what do you do, and what are you willing to offer in order to get your deal done, given you as the sponsor still are in a position, to Mr. Gensler's point, to make money even when the stock falls well below $10. And as we know, even though redemptions can be very high, these deals still get approved and rarely renegotiated.
Remember when Dave Coady started with Vertiv?
Yes, great SPAC.
What they looked
There
for,
are some,
they had a business they wanted to buy it.
There
They
are
worked the
deals.
other way,
There's
right?
no doubt.
They
There
had
are
a business.
deals
They want to buy the business.
that are good deals and that represent potentially good value over time, that have good management teams. But it requires a lot of focus from the investment community in order to. And so, with so many out there, it's hard, Carl, to know where to even go.
I hope that Gensler succeeds and people watch the video realize it's a